All right, let's just dive right into this. Welcome to The Explainer. Today, we are on a mission to transform you from completely clueless to absolutely chart literate. We're breaking down a super detailed, comprehensive source on day trading, and our goal here is pretty simple. We want to help you understand the mechanics of building sustainable financial independence by finally decoding the markets. So let's get started. So, what if I told you that you could practice literally the highest leverage skill in the world using entirely fake money? Sounds kind of crazy, right? But think about how unique that actually is. In pretty much every other business or side hustle, you have to risk real, hard earned capital just to learn the ropes and make those inevitable beginner mistakes. But as our source material emphasizes, day trading allows you to learn completely risk free before a single real dollar is ever on the line. Okay, here's how we're going to tackle this today. First, we'll look at the highest leverage skill, then setting up your toolkit, cracking the candlestick code, tracking market trends, and finally, the power of liquidity. And hey, don't worry if you're a total beginner. We're taking this step by step. So, part one, the highest leverage skill, and really, why day trading? The creator of our source material, TJR, actually brings up his own past failures with things like sneaker bots and dropshipping to show exactly why day trading stands out from the rest of the pack. E-commerce often requires huge upfront costs, gives you incredibly low margins, and at the end of the day, you're limited by the actual population of your specific niche. Day trading, on the flip side, is infinitely scalable. You are limited only by your capital, and again, you can practice on a free demo account. It's basically the ultimate scalable online hustle. Moving right along to part two, setting up your toolkit, focusing on software and execution. Honestly, this is the best part. Your barrier to entry is virtually zero, period. Step one, you do your charting on TradingView, which is completely free. Step two, you pick a broker. Now, our source uses Hero FX as an example, but there are plenty out there to choose from. And step three is opening that demo account. You just analyze the market over on TradingView, and then you execute your practice trades on the broker's platform. Now look at that number, $100,000. When you open that demo account, you can literally load it up with $100,000 in fake money. And I absolutely love the analogy our source uses here. If you've never played basketball a day in your life, you definitely aren't going to bet $1,000 against seasoned pros in your very first game at the park. No way. You'd practice for free first. Well, this demo account, that is your free basketball court. But what exactly are we even trading? Well, a Forex pair is simply a quote of one currency against another. Take GBP/USD, for instance. All that means is how many US dollars it costs to buy exactly one Great British pound. That's it. You do not need to be some macroeconomist doing deep research on British exports or biscuits. You just need to learn how to read the price action on the charts. Which brings us nicely to part three, cracking the candlestick code, or reading the snail trails. Every single candlestick on a chart tells a story of a very specific time period. The thick part, the body, shows you exactly where the price opened and where it closed. And those thin little lines stretching out at the top and bottom, those are the wicks. Our source fondly calls them snail trails because they trace the absolute highest and lowest points the price reached before snapping back. Now, a bullish or up candle just means it closed higher than it opened. A bearish or down candle closes lower. And look, whether your chart uses green and red or blue and black, the rules stay exactly the same. So when should you actually be looking at these candles? The global market runs in sessions. The Asian session kicks off in the evening Eastern time, but honestly, it has very low volume and is usually best avoided. The London session, however, opens up at 3 a.m. EST and is fantastic for high-volume Forex trading. And finally, the New York session opens at 8 a.m. EST, which brings massive volume for US indexes. The big takeaway here, you basically get to pick your own hours based on where you live. All right, let's jump into part four, tracking market trends and following the flow. Visualizing how you react to the market is absolutely vital. If the market is making higher highs and higher lows, you're in an uptrend. Your strategy? Look for buy positions. Go long. If it's making lower highs and lower lows, you're in a downtrend, so you want to look to sell. Go short. And if the price is just kind of bouncing sideways randomly, that's consolidation. Your absolute best move there is to just sit on your hands and wait for a clear breakout. And this leads us straight into a classic trading maxim that's heavily emphasized in the source material. The trend is your friend. Seriously, you never, ever want to trade against the prevailing momentum. Think about it. If the stairs are going up, don't try to ride a sled down them. Just follow the flow. Okay,
But what happens when that trend finally stops? That's called a break of structure, which happens when the current trend gets disrespected. But, and this is a huge but, here is the most vital distinction our source makes. In an uptrend, a true break requires a full candle body closer below the most recent low. If the price just dips below with a wick, one of those snail trails, and then closes back up, the trend is still totally intact. You have got to wait for the actual closer.
This brings us to our final and definitely most advanced topic, Part 5, the power of liquidity, the secret market engine.
Our source frames this as the ultimate concept, the true GOAT of trading concepts, that actually separates the retail losers from the wealthy institutions. Liquidity is simply resting orders. Above every recent high, retail traders have placed buy orders. Below every recent low, they've placed sell orders, usually as stop losses. And here's the crazy part. Big algorithms and massive institutions literally need these pockets of resting orders to fill their own billion-dollar positions.
So let's walk through how a liquidity sweep actually plays out in real time. Picture a downtrend, all right? Retail traders set their stop losses, which are sell orders, just below the recent lows to protect themselves. Well, big algorithms will purposely push the price down just enough to trigger all those sell orders. Then they scoop up those cheap sales to fill their own massive buy positions. Suddenly, boom, the market fiercely reverses upward, leaving the retail traders completely empty-handed. The market literally manipulated the price just to grab the volume it needed. To really highlight how pervasive this is, the source shares this wild anecdote about the 2020 market crash. They frame that event as a massive, high-time-frame global liquidity sweep. By pushing prices incredibly low, retail traders basically panicked into selling, and that panic provided the exact liquidity that massive algorithms and institutions needed to buy the dip right before a monumental, multi-year run-up. It's a pretty striking reminder that these sweeps happen on every single scale, from a tiny 5-minute chart all the way up to global daily charts.
Which brings us to our final thought, and honestly, a deeply important question for you to consider. Look, the market is going to show up tomorrow whether you are participating in it or not. The charting tools are totally free, the demo accounts cost absolutely nothing to set up. So the only real question left is, are you going to be tracking the trends and practicing on a demo account, or are you just going to keep sitting on the sidelines? Take some action, get familiar with the charts, and start building that high leverage skill today. Thanks so much for joining me.